Welcome back to the Economic Analyst channel. In this video, I'm going to cover the CPI report that came out for January 2022 that was released at 8:30 this morning. In this latest report, we note that the inflation numbers had come out and the month-over-month change was over 0.6%. It was actually pushing up to almost 0.7%, came out at 0.64%. Definitely higher than what Wall Street was expecting here, but it was in line with the final demand model that I have created using these metrics based off the fact that there's a strong correlation between the consumer price index and the producer price index for final demand. And based off of those numbers, it showed that, on the average, we were probably going to have about a 0.4% change in the CPI this month. We got 0.6. Now, I had suspected that we would end up on the higher side of this 0.4 and end up at around 0.6, and you can check my latest update on that, which was probably when the producer prices came out for December. That video, I probably stated that, I was expecting the numbers to come out a little bit on the higher end, and that's mainly because the consumer price index is unusually low as a percentage of final demand right now. The average, it usually hangs around 99.5%. Right now it's at 98.4%. So in order to start gaining back its ground against the final demand numbers, which have already been pushing up, and final demand numbers have been pushing up as high as 10% year over year, then the CPI would have to push upward. If you notice here in the month-over-month trends, the lows are constantly building and the peaks are constantly building here. This is suggesting that price inflation is becoming entrenched. It's starting to gain momentum, and we may actually have higher price inflation numbers for the year of 2022 versus 2021. Now, just because it's trending this way doesn't mean it can't reverse the trending, but right now the forces seem to be at work right now, with most of the world still shut down and reeling from the effects of COVID, with the supply shortages that we're having due to the increased demand, the excessive monetary stimulus that has been building in, and factor in that when monetary policy gets initiated, it usually takes a year or two for its effects to reach full maturity, which now, where it's the spring of 2022, monetary policy started expanding rapidly in the spring of 2020. We're getting hit with rampant price inflation, and it seems to be taking root here. Now, this contrasts to last month, where the producer price index for all commodities actually had a drop in December, okay? And final demand numbers were pretty weak. A lot of that had to do with the drop in energy prices. But as I'll go over the table increases in just a minute. But as you're going to see, energy prices have bounced back as I predicted, and now we'll probably see higher producer price numbers for this month of January, breaking that anomaly. When we look at the year-over-year inflation trend, the CPI stands at 7.5%. That's the highest annual rate that we have seen since the beginning of 1982. So we literally have to go back 40 years to see annual inflation rates this high. And markets have, reacted largely negative. At first, when markets saw this news earlier today, they seemed to brush it off. There was a little bit of a dip in the Dow Jones as well as the other stock indices, and they kind of brushed it off. But once it dawned on them a few hours later that this might mean that the Fed might engage in even more tightening of its monetary policy than what they were pricing in, that sent markets into a tailspin, and we saw the Dow as well as the NASDAQ 100, and then eventually cryptocurrencies spiral downward in the wake and threatening of rising interest rates. In the meantime, though, we're seeing a rise in gold and silver on these news because, again, this is inflationary. So gold and silver have kind of spiked a little bit today. No, I'm not saying this is the beginning of the bull market for gold and silver. Yes, I'll create a video on this detailing out where we're standing in the precious metals market, and that's going to be a different story. But certainly they were bullish on this news, those markets were, and for good reason. And that's because, with rising inflation, rising interest rates deflating the stocks and bonds, the money's got to go somewhere. The institutional investors have got to make money somewhere. and the likely culprit is to move into gold and silver. It's just that they're going to begrudgingly do that as they admit defeat, that their methods, the typical methods of making money by investing in the economy, is beginning to break down in the wake of price inflation here. When we take a look at the breakdown of price inflation, well, the inflation numbers are everywhere, okay? It's not concentrated in any one area. It's concentrated everywhere. When we look at food, it's concentrated in cereal, it's in meats, it's in dairy, it's in fruits and vegetables, and other food at home. Now, ironically, meats, poultry, fish, and eggs only had a 0.3% increase. So the illustrious, intelligent Democrat Representative Alexandria Ocasio-Cortez and the brilliant Senator Elizabeth Warren can no longer say that the inflation numbers are really caused by greedy meat companies. Because when we take a look at the year-over-year changes here, we see that when food is increased by 7%, it's increased all across the board. Fruits and vegetables are up by 6%. Cereals are up by 7%. Yes, meat, poultry, fish, and eggs are up by 12%, but everything else is too, and so are the beverages. And in addition to that, we're seeing that energy prices are on the comeback, and this is being led by a rise in the fuel oil sectors here, as well as in terms of utilities with electricity. So this kind of rise will increase. Now, they're not showing that the gasoline prices are bouncing back yet. That's coming because gasoline prices have started to spike in the month of February. So that's going to mean we're probably going to have even higher energy prices, month-over-month inflation, than what we were seeing this month, where this 0.9% was an annualized rate of 11%. The annualized increases in energy have been a whopping 27% from a year ago, and we're probably going to see another 2 to 3% hike in the month of February as gas prices come back with a vengeance, and the price of oil has reached around $90 a barrel. That has not been caught in this month's CPI index. When we take a look and strip out the so-called volatility sectors, which is food and energy, again, core inflation's up by 0.6%. It's in clothing, it's in shelter, it's in medical care, it's in transportation. It's just about everything right now. Now, shelter is still lagging behind what we're seeing in the private sector indices. And even though rent of primary residence and owner's equivalent rent are following in suit with 0.5 and 0.4% increase, shelter's only at 0.3% increase this month. What gives? What's causing that? Well, when we take a look at shelter, it's the lodging away from home. That had a drop of 4%. What was causing that? Motels and hotels. I'll give you two guesses, but you're only going to need one on what's causing the drop in prices at hotels and motels. It's COVID. It's the variants. It's the fact that people are canceling their vacation trips because of the Omicron situation that developed in the month of January. With Omicron going away, absent of a new variant taking its place with that much of an infection rate, as well as the symptoms and increasing hospitalizations, we're probably going to see these prices come back up, and that's going to push back up the shelter prices in the future. So next month's CPI, not really looking good. Add to that we're seeing more and more shortages as more and a broader range of goods are getting hit by the supply constraints in the wake of increased demand. We're having more money chasing the same amount of goods, driving up prices further. Now, Tuesday, I'm going to give you more of a breakdown in the final demand to give you the outlook on just exactly where the CPI should land, give or take, for next month. But based off of this, judgment here is probably looking like on the greater side of another 0.5% increase at a minimum. That should be where that average lands, and we'll more than likely see that in the month of February. When we take a look at what's been transpiring in the CPI, when we look at the average median prices here, and just give me a second to go through here right quick. Let me recalculate the changes. We see that the average inflation rate month over month is about 0.5%. That's what I had it at before. And the median is also showing a similar number. The median inflation rate is about 0.5%. So if we take that conservative estimate, we're looking at inflation ending up at 6% for the month. And that's indicative of a 60% confidence interval in the US dollar. This is certainly a lot lower than what we were seeing for the past 20 years when we saw a record strong confidence in the US dollar of around 70%. And indeed, we're beginning to see this start to shake. And if it continues down this route, if it continues on this round for the year, then we'll only see it end up at about maybe 69% on the confidence interval. But that's really just looking at the fact that we're going by the average and the medians. Again, like I said, if we go to that to a 0.7% increase and show that month over month change for the rest of the year, then this is going to drop to 63%, and that's going to show you that the confidence for the last 3 years in the US dollar is starting to shake, and we might be seeing a situation develop akin to a run-up in inflation in the early parts of the 2020s, like the 1980s, before they abate as monetary policy plays catch-up to the inflation rates. Now, unfortunately, interest rates are highly negative right now, and as long as they stay negative, policy is still very accommodative to price inflation. And as the CPI becomes more and more entrenched in month over month, year after year, it's going to be harder to bring down those numbers. Even with a tightening Fed policy on the inflation front, it will probably take another year or two before it really takes root and starts calming down those CPI and PPI numbers. So we may be starting to see a falling confidence in the dollar as the money supply eventually slows, but the price increases have not slowed along with it. Now, that being said, the risk to all of this is obviously if the Fed raises rates too high too soon, it could cause a deterioration in the credit markets, could cause a bursting of the credit bubble, could lead to a massive deflation from credit defaults, and that might bring down the CPI and producer price index, but it will be at the expense of a huge, very bad recession, maybe even a depression in our economy. That's a story for another video, though, and I've covered that in previous videos. But right now, this is where the inflation numbers are standing. So certainly not good. There was a little bit of hope when the producer price index came out for the month of December that we might start seeing a calming down. But based off the consumer price inflation numbers coming out this month, inflation is still there. The money supply is still cranking up on the average of about 1% per month. So that's 3% per quarter. Definitely indicating there that we're probably going to see about at least a 6% annualized inflation rate, probably going to be closer to 9% this year from what it's looking like, especially when we factor in debt growth. So until we start seeing those numbers abate, probably not going to see that calming down in the inflation numbers. And even if we do see them abate, it's going to be a little bit of time before they start calming down, and it probably won't calm down until 2023. Guys, thank you for watching this video. If you have any questions, please let me know. Drop a comment. Let me know what you think about all of this. Is there anything that I missed? Is there some kind of insight in there about what's going on? I'd love to hear your thoughts on this. Just make sure you click that like button if you like the content that I'm providing. Show me some support that way. Subscribe to my channel if you haven't already. Click that notification bell, and you'll be able to get new updates from my vids as soon as they upload to YouTube. Once again, guys, I thank you for watching this video, and I'll talk to you next time.